Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about changes in retained earnings and the types of adjustments and changes and principles, etc., that can make our retained earnings number appear different than it did originally. We've talked so far about two of the four, changes in estimates and changes in principle. And in this segment, we get to wrap up the change in principle method so that you can see how it finally actually changes the retained earnings account. That's the one thing we haven't done yet. So just as a review, we've been talking about DSI Incorporated and their decision to move from FIFO to average cost as their inventory method. We've done a lot of calculations with this. First off, I gave you the step one portion where I recalculated inventory and cost of goods sold using the average cost. So here are the original numbers up on top. Here are the new numbers down at the bottom. That's step one. Step two was to recalculate retained earnings, and we walked through that together. Step three was to recreate the financial statement. So there's an order to the financial statements. We start with an income statement. We can use those numbers to do our statement of retained earnings, and we can use those numbers to create our balance sheet. And we could also change our statement of cash flows. But since I don't actually need the statement of cash flows to do the journal entries, we're going to stop there to save some time. So let's go ahead and do step four, the journal entry. I'm so excited to be able to do this. The journal entry is going to depend. It's going to depend on when we decided to make the change. Did we decide to do it at the beginning of the year, or did we decide to do it at the end of the year? And we're going to do this both ways so you can see them. That and I get to do extra journal entries, so that's always good. Let's start assuming that we made the change at the beginning of the year. Think about this for a second. What two accounts would be affected if I were to make the change at the beginning of this year? Well, a lot of people, when they jump into this, start thinking, well, let's see, cost of goods sold is different, inventory is different, retained earnings is different. Now, wait a minute, though. Only two of those accounts would actually be affected at the beginning of the year. Why two? Well, because cost of goods sold from previous years has all been closed into retained earnings. So I don't have a cost of goods sold to worry about. It's at zero. So I'm only going to worry about retained earnings and inventory. Basically, I'm only worrying about the permanent accounts. If I close at the beginning of the year, all of the temporary or income statement accounts are gone. They've been closed to zero as part of my closing entries from the last year, so there's no balance to worry about. Let's take a look at these two accounts. What we're looking for is the balance at the beginning of the period. So to do that, let's go back to our numbers as they were originally reported. So let's start with retained earnings. Retained earnings in year 5, beginning retained earnings would be the $125,000. It's not the number from our step 2 calculations. It's not the number from our step 3 financial statements, because now I'm trying to do a journal entry and I haven't changed the actual account balance yet. All I've done is change some numbers in some tables and financial statements. To do the journal entry, I have to look at what's actually in the account. And what's actually in the account, retained earnings, right now, January 1, year 5, would be this $125,000 number. So that's what I need to use, is that 125. What's in inventory? Well, beginning inventory for year 5 would be ending inventory for year 4. It's at this $18,000. So let's get those numbers in there. So retained earnings has a credit balance. We're currently at $125,000. Inventory's got a debit balance. We're at $18,000. Now, what do I want these numbers to be at the beginning of year 5? Well, I can see it in several places. I can see it here in my adjusted balance sheet. I can see it here in my retained earnings as reported, or down here as the desired ending inventory for year 4, or I can see it right here. So I've got this number everywhere. It's easy to find. So I want to be at 120,000. To get from 125 to 120 would require a debit of 5,000. So that's my first number. Now let's take a look at inventory. It's at 18,000. Where do I want it to be? I can find this in a couple of places, not as many places, but I can find it here. There's my inventory. At the end of year 4, I want it to be 13,000, which would be my beginning for year 5. So I can see it there. The other place I can see it is in my beginning set of numbers, my step 1 calculations. It's right down here. This is what I want any inventory to be under the new method. Either way, I want it to be 13,000, and inventory's got a debit balance, so I want it to be 13,000. Again, I'm moving from here to there. This time I need a credit of 5,000, and lo and behold, the debit and the credit match. It's just like magic, or like accounting, in the way we set it up on purpose so that it does balance. I need a debit to retained earnings, 5,000. I need a credit to inventory, also 5,000. This is to adjust the permanent accounts for the change in inventory methods. And again, up to this point, everything we've done is just changing numbers, tables. We haven't actually done anything to the accounts until we actually make a journal entry and change what's in there. Now, what if we do it at the end of the year? Well, at the end of the year, I still have to change the permanent account. So these two are going to come down here. But at this point, I have one more account that's involved, because if this happens at the end of the year, then I've spent all year running cost of goods sold under FIFO, and now I want that number to be weighted average. So I've also got the temporary accounts that I've got to worry about. The only difference is I'm only using this year's part of these temporary accounts. So again, let's take a look at ending balances. Now you can find this in a lot of different places, but all of the information we need is on that original table. So instead of jumping through multiple places, I'm just going to go there. You can find some of this information at other locations, but for the sake of simplicity, cost of goods sold originally is 90,000. I want it to be 93,000. So let's do that. Cost of goods sold has a debit balance. It's at 90. I want it to be at 93. If I'm going to go from here to there, I need a debit of 3,000. Again, to see inventory, let's go back to that beginning slide. Inventory at the end of the year is at 30,000. I want it to be at 22,000. So let's put that into the T account. At 30, I want it to be at 22. So to go from here to here, I need an $8,000 adjustment. Last thing we need to look at is retained earnings. So what would retained earnings be? When I do this in class, 9 times out of 10, I get the wrong answers. What most people say is, well, let's go back to our tables. And they go back to these numbers and they say, well, we're at 163 and we want to be at 155. So we need to make this adjustment. But that's not right. When we're talking about journal entries, we only change retained earnings twice during the year. Once is to make an adjustment, which is what we're doing. The only other time we change retained earnings is when we do closing entries at the end of the fiscal period. That's it. Corrections and closing entries. Well, have any of these adjusting entries been made yet? No, this is the only one. So I haven't changed retained earnings for any adjustments or corrections. Have I done closing entries yet? No, that happens later after the financial statements are all done. Everything's balanced. I'm sure it's ready to go. I have finished the audit. I've checked everything. I'm ready to get everything started for the next period. Then I do closing entries. I haven't done them yet. If I haven't made any adjustments and I haven't done any closing entries, then what's the current balance of retained earnings? It's still at 125. Because I haven't done anything yet. Remember, these are mutually exclusive. I either do it here or I do it down here. I don't do both. So I'm still at 125,000. What kind of an adjustment do I want to make? Well, I don't want to change all the way to the new ending retained earnings balance. That's that 155 we've looked at before, because that includes all the closing entries. I want to get from the 125 to this number. That's exactly the same as what I did before. I want to get to the 120. Then I'll make my normal closing entries with the new cost of goods sold number, and it'll flow out to be this 155. So the retained earnings piece is the same for beginning and ending. Those two will always be the same. And that's one of our key concepts for doing changes in principle, is understanding that while other permanent accounts and temporary accounts have changed, retained earnings will not change until we make this correcting entry and then do the closing entries when it's all said and done. So because of that, the entry for retained earnings is the same. So we're still debiting retained earnings for 5,000. We're debiting cost of goods sold for 3,000 and crediting inventory for 8,000. And lo and behold, it balances as well. One other quick aside, just to make sure we emphasize this. Remember, retained earnings is keeping track of all of our profits and losses, the net amounts of those after dividends for all the previous years of my business. It doesn't keep track of this year's stuff. It keeps track of prior year's stuff. That's the other reason why the change is based on past stuff. The 5,000, that's the difference in net incomes. If we were to net them out over these previous years, would be the $5,000. Let me show you. If you look at the changes here, -10, +3, -1. We didn't write this adjustment down, but I'll give it to you quickly. It's a +3,000. This is the last one. So if I add these up, -10 + 3 -1 + 3 gives me a -5. That's why retained earnings is that -5,000. It's summarizing all of these previous adjustments to net income, because that's what retained earnings does. Now, we've walked through all of these principles and calculations that are the change in principle. When we come back, it'll be time to move on to some of the other adjustments that we make to retained earnings. We'll see you then.